And here's the key point. This will be year 10 in a business expansion. If we get through fiscal 19 with this massive borrowing without a recession, it will be month 124 of the expansion that started in June. That would be a historic record. That would be beyond the all-time record of 118 months in the 1990s when, as everybody here remembers, it was a far more benign environment. So if we look forward, we're going to have a tremendous, as I say, collision in the bond market, and that's going to reverse this whole giant bubble that has been building for the last 9 years.
David, so I think it's pretty easy to take a few data points and come out and talk about the end of the stock market or the bond market. But I think for viewers at home, it's very important to note that over the last 100 years, being invested has been a good place to be rather than not being invested. So for people like yourself who see the market just imploding, there's ways to bet against the market. But I think for most people at home who are watching our program, the doom and gloom, kind of the headlines can sell, but history says that being invested in the market is a better place to be than sitting in the side.
I wouldn't disagree.
I comment how stupid that is.
Yeah, sure.
Like, if you can clearly look at a chart and say, hey, this is a good time exiting the market, like, this guy's basically, well, don't do that because in the overall, yeah, well, you can put your money on the sideline for a little bit and hop back in.
Yeah, that's right.
There's no reason to just hang in if, like, you can pick, like, if you can time it, fucking time it.
Yes, and I believe Stockman does respond to this point. But yeah, of course, you're right. I mean, like, what a ridiculous thing to say. It's like, well, yes, if you had your money invested in companies for 100 years, sure, that's better than not investing your money over the last 100 years. But how about let's pick some different dates, you know? How about if you bought the stock market in 2007 and pulled your money out in 2009? Was that good?
Yeah, or you can even argue that, like, if you took Stockman's perspective, you could say that most of the growth is actually government bubbles,
right,
and that the natural course is that speculators get wiped out. And so my real advice to you would be not to be in the market, because at some point you're going to have these fantastic corrections, and maybe it happens right when you got to retire.
Right. Now, of course, right, let's just to flip this around, to take this guy's logic and apply it towards something else. Okay, well, in the Bretton Woods Agreement, gold was pinned at $35 an ounce. I don't know what gold is as we're speaking right now, but it's way higher than that. So yeah, if you had invested in gold since since say the breakup of the Bretton Woods Agreement in whatever it was, 71, 72, something like that. If you had invested in gold since then, you've done quite well for yourself. What's the current price?
Per ounce, 1,326.30.
Okay, so it went from $35 to $1,300 and change, right? So same exact logic right there. So just by taking your money out of the market and putting it in gold, you'd be better off to be in that.